All right, perfect. We are live. If you're on Facebook,
Right.
you can join us at kwdentonlive.com, or you can post your questions in comments below and I'll get them asked on Zoom.
Okay, perfect. Well, how is everyone today?
Doing good. Just got back
Good.
from vacation.
You just got back from vacation? I want to go on vacation.
All right.
Where'd you go?
At Florida.
Oh, nice.
Yeah, just outside of Orlando. So we went to beaches on the east and the
Cool.
west coast of Florida. So I got to see all of it. Except for Miami. I stayed away from there. No Miami.
Yeah, it's a crazy place.
Mm-hmm.
Nothing to see there, really.
Just a lot of COVID cases. So
Yeah, no kidding.
Nope.
Well, good deal. Well, we're just gonna kind of I'll start doing teaching on classes, and then y'all throw in any questions or any things that you can think of, because I believe what we're gonna try to do is cover some of the loan programs and the ins and outs, and things with COVID have kind of pretty much underwriting, at least for us, has gotten back to normal. We did have some crazy things going on, but it's pretty much normal. The only thing that's really different is we just keep updating people's paycheck stubs throughout the process to make sure they didn't get furloughed or laid off. Before, we just used to do a verbal verification at the end and make sure they're still working there. But what we've been doing now is making sure if a bank statement's been updated, we get that, and if the paycheck stub comes in between what we have and during closing, we'll get that usually, just to be safe. But other than that, it's pretty much status quo. So we do have the traditional conventional loans, which you can do as little as a 3% down payment if needed. So that's a really good program. And with good credit, the rates and the mortgage insurance are pretty similar to a 5% down loan. So on conventional loans, if you're under a 740 credit score, you're going to have a hit to the interest rate and also a hit to the mortgage insurance if you're putting less than 20% down. And 700 and 720 scores, the hit isn't too bad. Starts getting worse below 700, and if you're below 680, it's huge. So if you're below 680, a lot of times we look at the FHA loan because the payments will be better. Conventional debt ratios, depending on your credit profile and the down payments, sometimes we get capped at 45%. Sometimes we can go up to 50% on the debt ratio. Just each file's a little bit different. Each borrower is a little bit different. FHA, I've done loans up to 55% on the debt to income ratios. Underwriting is a lot more forgiving. You do not have the credit score adjustments, so it's much easier to get approved. The only drawback on the FHA loan is the upfront mortgage insurance, which is 1 3/4%. So if you're putting down a 3.5% down payment, it's almost like you're losing 1 3/4% of the down payment because you're financing more. And the mortgage insurance is not for the life of the loan, so you have to keep that forever unless you're putting at least 10% down. That's the only other drawback. Any questions on that aspect of it? Okay, and then kind of went over the FHA loan, which is a good loan as well. Much lower credit score requirements, easier underwrite. Sometimes 3 and 5% down loans on conventional, you can't even get the automated underwriting approval, but FHA, they'll go, it's a pretty easy loan to get approved on. And then we also have the USDA loan, which is a true no money down loan. Great loan as well. Though that is area and income restricted. So on the USDA loan, depending on the area, if you're 2 streets over or if you're in a different city, you may not be able to qualify for that loan. The tricky part of that is we count all income in the household to go towards the income limit. So if you have a wife that's working or a husband that's working that doesn't have credit to be on the loan, you still have to count their income. And if it's a multi-generational family and you have a mom living with you that gets Social Security income, we have to count that. And if you have 16 to 25-year-old kids living in the home that are working, we have to count that income too. And some things that could get you is they won't look at last year's income. for the income limits to look at this year. So if you get a bonus at the beginning of the year, that could be annualized, and meaning it looks like you're making a lot more income than you really are. And that's caught a lot of people on USDA loans. So if you get a $4,000 bonus at the beginning of the year, they're going to take $4,000 divided by 3 months and carry that over 12 months. So it looks like you're getting that amount for the whole year.
Question on that.
Mhm.
The government money that they just sent for COVID, did that count towards USDA as well?
That is a good question. It shouldn't, because it's a one-time deal.
Well,
And
maybe
debt
it's
ratios
one
on debt ratios are really, really tight on USDA. So you have you have a front ratio and a back ratio. The front ratio is your house payment divided by your income. The back ratio is your house payment plus any other debts. And USDA gets really, really tough if you go above 29% on the front ratio.
Mm-hmm.
So you can get an FHA loan or a conventional loan done at 35 or 40% on the front, and there's no way it's going to get done on a USDA. And they also want to be really close to the 41 to 43 debt ratio on the back. For FHA, you go up to 55%, which lets you qualify for a much bigger house too.
Mm-hmm.
And with all these loans, we can use the state grant, which is a great program. You can get down payment money as long as you're under like 99,600 on income. And that's whoever's just on the loan too. You could have both spouses working, and if one spouse can qualify, we don't have to count the other one's income if they're going to go over that limit.
Nice.
So that's really, really helpful. We've been doing a lot of those loans lately. You can get 3, 4, or 5% of the loan amount to go towards the down payment and or closing costs. So if you're doing a 3% down conventional loan, you can get 3% back, have no down payment, and just come up with closing costs. I have one girl that's doing 5% back right now. So doing 3% down, so you got 3% to go towards the down payment and 2% to go towards closing costs.
Is that just for first-time home buyers or anything?
No, it's for anybody. So really, really good program. Good way to get people in for a lot less money.
Yeah.
Yeah, because she's buying like a $230,000 house. It's getting like $11,000 to go towards her transaction.
Yeah. So is the only restriction on that their income, or are there other restrictions?
Income. On an FHA loan, you can do it where you don't have to pay it back. On a conventional loan, if you move or refinance in 3 years, that has to be paid back. So that's something to keep in mind. That's fairly new for them. You didn't have to pay that back until about probably 4 or 5 months ago. But it's still a great program. Most people are planning on staying there 3 years. I mean, things do happen, so they got to be aware of that.
Mm-hmm. So Karen has a question. Is there a handout for these different loan types that maybe we can get to the...
I can create some stuff, yes. Marketing flyers.
Okay. And she also asked, is that TSHCH?
Yes. They say it's T-Shack, but it doesn't spell that way.
I was not even going to try to...
Yeah, it's Texas State Affordable Housing Corporation. But the A and the H when you say T-Shack is like reverse, so it kind of throws you for a loop. So it's a great, great loan, great program. I do a couple of those a month probably.
Mm-hmm. Perfect.
More than that, some. I think I have 4 of them going this month.
Nice.
Yeah, the first-time homebuyers really love that program. Reduces their cash.
Deanna's asking, is there a minimum credit score for that program?
Yes, 620. And if you're between 620 and 640, they're going to charge you 0.5% of the loan amount. So a $200,000 loan, if you're at a 639 credit score, you're going to pay an extra $1,000 because of the credit score. So if you can get to 640, that's ideal. And the good thing about that program too, you can do some conventional loans and they don't have the Fannie Mae pricing adjustments. So you might be able to have a rate that's the same or better than a Fannie Mae, Freddie Mac rate and still get 3 or 4% back because they don't have the adjustments to the rate. It's wonderful in that aspect.
Mm-hmm.
Had a guy that got like an eighth lower or a quarter lower in rate and got 3% back than we could do on a traditional deal because the adjustments are so severe. Because he had like a 640 something credit score.
Nice. So that'll go with any loan type?
It'll go with any loan. It'll go VA, USDA, FHA, or conventional. So VA loan's a true money down loan as well. And there's no monthly mortgage insurance. You just have to be a veteran, which we do a lot of those too.
Mm-hmm. So what are some, you want to talk about the VA loan for a minute?
Yes, VA loan is just veteran based. Debt ratios on that can go fairly high. A lot of things that will trip people up on VA loans if they're not experienced on them is the residual income requirements. You could have your debt ratios in line, everything looks good, but on a VA loan, they add back into your debt ratio expense, the income taxes that you make. And then also they use a factor 0.14 times the square footage of the home. So if you have a 3,400 square foot home you're buying, that's basically like having another $476 a month debt. And your debt ratio may work, but if the residual's over, you can't get the loan. And that can happen quite often if you're buying, at the maximum what you can qualify for. So we take care of the veterans. We have the Wounded Warrior Initiative. We used to give away mortgage-free homes to wounded veterans, and we gave away like 27 of those, but that's a huge, huge amount. I mean, you give away a $180,000 home, that's a lot of money. Mm-hmm. So what we started doing is instead of giving a home and only helping one veteran, we've given more to do other things so we can help 50 or 100. I mean, right now we're doing service dogs. I think we might do 100 service dogs this year.
Nice.
Yeah, it's great.
So are there some drawbacks on VA that might make a person not use their VA?
The only reason why to not use your VA is if you have money to do a conventional loan. And the reason why I say that, if you're a second time user and you have the funding fee and putting no money down and you're paying, over 3.3% funding fee, and you have to finance that into the loan and you try to sell it in the next 4 or 5 years, you're going to be upside down. It helps on monthly payment because you don't have any mortgage insurance, but that funding fee, you're buying a $300,000 house, you're financing an extra, could possibly be financing an extra, 10 or 11 grand on top of the no money down aspect of it. So if you're already 3+% upside down and then have real estate fees when you're trying to sell it, you're going to have some issues. Anything else you can think of on questions?
Jan, you got one?
You're muted.
There you go.
There you go.
I had a question specifically about, I have a client that is going to purchase a home, but wants to keep their current home as a rental.
Yes.
And so just trying to figure out exactly, is that any different from a contingency standpoint, or what are the requirements from a lending standpoint if you need to have that home leased in order to buy?
If you can get a lease agreement, on the property, then we can use 75% of that to offset the payment.
75% of it.
Yeah, if you're going to be leasing that out, you start marketing your home before you go buy the new one. Mm-hmm. And let's say you have a tenant that's going to be renting a home for you can get an $1,800 a month lease. 1,800 times 75%, you can use $1,350 to offset that mortgage payment for qualifying purposes.
Okay. And that's a universal rule?
Correct.
Okay. So as long as you have that in place, mm-hmm. then
then you can look at it. And some people can qualify with both payments regardless and don't have to worry about a lease. But,
Yeah, I don't think they can.
yeah.
So
You know,
just
we can run the numbers and see where you're going to be. Do you know about how much they could lease their house for?
probably about 2,200.
Okay, so you're looking at 2,200. Thinking about 1,650 to offset their current payment.
Okay.
You know what their current house payment is with taxes and insurance and everything?
I think it's probably at least 2.
So you might only have to charge $350 a month of that debt,
Yeah.
which is a big difference.
Okay.
Couldn't you cash out refi that?
Well, you could, but it's not going to change the debt ratios. And what you're going to have to do is you'd have to do a cash out refinance and classify it as a non-owner occupied property because you can't refinance a primary residence and then buy a primary residence.
Right.
Lending guidelines will say that's loan fraud if you knew you're going to be buying a home, even though you're not purposely trying to do it.
Mm-hmm. Okay.
Years ago, a client did that we had, and title companies will do an MERS report, and I think they were actually going to stay where they were going to be too, which is kind of a bad deal. But they did a cash out refinance as a primary residence, and then went immediately and bought a new home. And they're like, you can't do 2 primaries, so we can do one of 2 things: we can report you, or you can sell that property.
Right.
Which
I guess they could refinance their first home.
you just classify that as a non-owner, and you're fine.
Yeah.
As long as you say, I'm refinancing, I'm taking cash out, but this is going to be an investment property, then you're fine. And the only difference on that is you're limited to 75% of the value, to where on a primary, you can go up to 80%, and then you're going to have the higher rate because it's non-owner occupied.
Yeah. Okay.
But it can be done if you need the money for a down payment on a new house.
Gotcha. Well, I'll try to steer them your direction. Oh, steer, that's a bad word.
Yeah.
I'll try.
No word.
Yeah. I'll be more than happy to
I'll
talk to them.
suggest that they give you a call.
Yeah, and then they can know all the ins and outs, and they kind of go from there.
Exactly. Thank you.
Oh, you're welcome.
So are there any other first-time home buyer programs or anything that may be better than that one you're running now? But
There are other ones out there, but I think that's one of the better ones, especially on FHA, because you don't have to have that forgivable second mortgage for the down payment grant that's paid back. You can get in on an FHA loan, and if you sell it a year down the road, you're fine. But on a conventional, or if you use that forgivable second and you sell in 2 years, you're going to owe that money back. They're going to put a lien on the property, and that's got to be paid off when you sell the house. And hopefully that doesn't make you upside down.
mm-hmm. Does that only work for, does that only work for your down payment? Can you use
No, you can use it towards down payment or closing costs.
closing costs? So could you combine that with maybe your VA loan?
Yeah, I've done VAs and USDAs with no money down and used the 3% back to pay all closing costs in escrow account and get the earnest money back at closing.
Nice.
So you get in the house for zero.
Mm-hmm.
It's like, all right, and I've actually done it before on an FHA and the USDA, where they got back the earnest money, the option fee, and they prepaid their inspection fee, and we got that money back too.
Nice.
So they got in literally for zero.
That's only if you're buying a new home. You couldn't use that for like refinancing or anything, right?
No, yeah, it's only for a purchase. You can't do it on a refinance.
All right, I am checking Facebook to see if anybody else has any questions. I know you guys don't do loans on mobile homes, but
Yes, we do.
You do? Oh, I didn't know y'all did that.
Yes, we do.
Awesome. You want to talk about how that works? Because I don't think a lot of agents know.
Yeah, it's mobile homes are the hardest part is just making sure they're tied down properly. You got to get an engineer's report to verify that. And if the property it can only be from the dealership to its original location. If it's been moved, you're not going to get a traditional loan. I think there might be one type of company that'll do an FHA loan, but it's tough.
So it's a conventional loan then if you guys do it?
No, I mean, if it's been moved, we're not going to be able to do it.
Ah, gotcha.
I think
How
there
does an
might be a
agent find
company
that?
that does them, but I'm not sure how they're getting around it.
How does an agent find out if it has been moved, if the seller does not know?
That's a good question. It's tough to find out.
How do you find out?
You should be able to tell if it's been put there right away from the county records, I believe.
Okay.
I've never really run into it, honestly. They've always known or they haven't known. I mean, they've always known or it hasn't been moved.
Right.
And if they know it's been moved, that's where you run into a problem.
Mm-hmm.
You have to think about that one for a second.
I have run into one that has been moved before and the seller did not know it, but it was a
Yeah, because everyone I've run into, they knew it's been moved. So I've never had it pop up.
mhm. I just can't remember. I think there was a death in the family and that's why they weren't aware that it had been moved. So
Yeah.
Karen is asking, is that an FHA loan for the mobile home loan?
We can do FHA or conventional. USDA, if you're doing that, and I had to check their guideline on that. I know as of about a year or two ago, last time I looked at it, they want that manufactured home to be built on or after January 1st, 2006. So if it was built in 2002, USDA doesn't want it.
Okay.
Or even 2005, January 1st, it'll be too old. So I have to see if they've updated that, if they've made it newer or lessen, or what they've done on it.
Mm-hmm. If they have she says, does it include the property on it? What are the score requirements?
I'm sorry?
She says, does it include the property on it and what are the score requirements?
Yeah, you need to have the land on it as well. You can't do it like in a mobile home park where you're leasing the land.
Yeah, it's not real property unless it's tied down to.
Yeah, it's got to be. That's the main thing. You got the engineer's report. Make sure it's tied down properly.
Mm-hmm.
And land, you just got to have comparable sales on it.
Mm-hmm. What's the score requirements? Does that change?
620, 620 to 660. I think conventional they want 660. And I have to look at that too because I haven't looked at it since pre-COVID, but it should be back to normal.
In case they run, and she says, okay, thanks. What loan types can you use on land if somebody's going to buy land and then build on it?
You're going to have to go to, it's a non-Fannie Mae, Freddie Mac FHA loan. You got to go to a land bank to get that financing done. And usually they're about 25 to 30% down payment.
Okay.
And once you build on it, you can refinance that land loan into you treat the loan as a refinance and refinance that and do the construction for the new home.
Anybody else have any questions? Karen is asking, what do you mean land bank, and do you have any recommendations on a land
No,
bank?
I don't. I don't know who to refer anymore. I used to have a lot of them, and then years ago when that product kind of went away, I don't know who. I don't have any contacts that would be reputable to direct you to, other than it's almost like pulling out a phone book or Google, I should say. I don't think there's phone books anymore.
I've seen the yellow pages, but I don't think I've seen the white pages anymore. Anybody knows of a good land lender, you can always put it on Facebook, and that way others will see it.
Diana?
Yes.
This is Cindy. We used Lone Star Ag when we bought our ranch. It sits over there by the old Sally Beauty back
Yeah.
in by the appraisal district. I think
Oh,
it's
yeah?
more Lone Star Ag. I used a guy named Craig. He was really good.
Yeah.
Yeah, but that's the only people I
I've
know.
heard they were good before now that I think about it. So
Are they still there? I mean, I think they are.
I
I
don't
haven't.
know.
had
I
to-
have no idea.
So
Haven't heard anything bad about them, so that's a good thing.
Yeah.
no news is good news.
Exactly.
Okay.
Karen says, I'll Google it. Thanks for but that was before Cynthia, your
Yeah.
recommendation. But she says, thanks for the info. I have several clients interested in mobile homes and land. So
Yeah, we can do it. If there's a structure on it, we can do it. But if it's just land only, we can't. It's not a generic product. A Fannie Mae, which would be a conventional FHA or USDA or VA.
let's say they have a client whose score is a little lower. What kind of recommendations can you make as to maybe how they can get their score up a few points?
It depends on what's on their credit report. You know, the easiest way to get your score raised if you have any credit cards with high balances. You know, paying those down could get you anywhere from 10 to 70 points. I mean, I had one girl, she had limited credit history and she was at a 667 and paid down her Discover card and it went from a 667 to a 770.
Whoa.
Close to the limit. She'd bought a bunch of things on it. She was like, I paid it off, and we updated the did a rescore on it, and she was at 770, which is huge on a conventional loan. She was putting 15% down, so I got, you know, way cheaper mortgage insurance and a lot better interest rate.
Yeah. What about medical on their credit? Does that affect anything, like medical bills?
It could, yes. It doesn't. It seems like it doesn't hurt your score as much as a regular collection, but they're still going to be on there.
Mm-hmm. Does that count toward the DTI or anything?
No, not really. No.
At what point does a credit card balance start counting towards your DTI?
A credit card always counts towards your debt ratios. It's just your credit scores. If you have a $500 limit and a $400 balance, your score may be 50 points lower than if you had a $10 balance.
Right.
And we're going to use whatever the monthly payment is for the debt ratios. So if you pay it off, then you don't have to count that card in your debt ratio. Some people pay off their cards every month, but you just got to verify that it's paid. I've had people pay them at closing before. Make sure they qualify.
What are some of for maybe our newer agents, some of the things to remind their buyers not to do while they're in contract?
Do not buy anything. Furniture, cars, anything. Because on a conventional loan, we have to do a credit refresh. It's not a hard pull, but if your debt ratio, if you're at a 44 ratio and the maximum is 45 and you go buy new furniture, your ratio may be too high. So do not do that.
Mm-hmm. Do not sign a lease for your kid. I've seen that one happen.
Oh gosh.
They co-signed on a lease for their kid who was moving to college, and that threw them out.
Lease on a car?
No, on a house. It threw their debt to income ratio out.
Well, they know they signed a lease on a house.
I have no idea, but I know they found out.
Wow.
Yeah. What else can they do right before, while they're in contract that could?
Yeah, don't quit your job. Don't buy new things. Don't make large deposits in your bank account that you can't paper trail and plan on using that for closing money. You can't just go stick $6,000 in your bank with cash. We can't count it. Don't get a loan for anything unless it's from an asset like a life insurance policy or 401k, because we can't use that. Those are the main things. And don't miss any payments. Don't forget about a credit card payment
Yeah,
or an auto payment or anything.
I'll do it.
I've seen it happen. It's not good.
highly likely if they do that, they're probably out their earnest money if it's that late in closing too. So
Yeah. Oh, don't go get married while you're in the process of buying a home if you're doing an FHA loan.
oh,
That happens quite a bit because then you got to count both spouses' debt on an FHA or USDA or VA. It's like, oh, we went and got married this weekend. It's like, okay, great. You have to count your new husband or new wife's debt.
and maybe not their income.
Yes, I've seen it happen.
Oh no.
And I've had it happen where everything was fine, but still, I mean, I had that happen not too long ago. Told the guy at the beginning, I said, you're engaged, don't get married before closing. He was like, yeah, my wife just wanted to, so we went to Vegas this weekend. I was like, all right, we got to pull a credit report.
Oh gosh.
Didn't
I
affect the
wouldn't have thought
ratio. Thank God she didn't have any debt, so it didn't affect anything. But if it did, it could have killed the deal. Either that or you have to go to conventional.
Mhm. Yes. One of the agents I worked for had the 10 commandments of buying a home, things to do and not to do. And one of them was don't go buy a car because you might be living in it.
Yeah, true.
I liked that one. That one always made me giggle.
Yeah.
Anybody have any other questions? I don't see any.
Let me know if you have any questions or need help with any buyers. I'd be more than happy to help you out.
All right, well, I think we just had a question about the handout for the different loan types. If you want to get that to me, I'll get it posted on our internal Facebook group so everybody can grab that.
Okay.
All right.
All righty.
All right, well, thank you so much for the class.
Yes.
All right.
Thanks, Robert.
Thank you.
Thank you, Robert. Aren't you with Fairway?
Yes.
Okay, I wrote your name. Okay.
Two doors down.
Huh?
We're 2 doors down from the Keller Williams office.
Okay.
So if you ever need anything, of course, our office is still closed, but I still go up there every now and then just to get out of the house and do something different and work up there because no one's there.
Yeah.
Thank you so much.
You're
All
welcome. Have a great day.
Have a great day.
Bye.
Thank you. Bye.
Bye, Karen.